Aneel Waraich, Executive Vice President and Director of Steppe Gold Limited, listed on the Toronto main board of the Toronto Stock Exchange. We are a gold and silver producer in Mongolia, now producing from our oxide mine, expanding into our sulfides over the next 18 to 20 months, which will take our production profile to over 100,000 ounces for another 12 years of mine life, with another asset we've just acquired in Peru, which is a large 2.4 million ounce development project that has also oxides and sulfides, very similar to Mongolia. So we are a gold producer expanding with now multiple assets in multiple jurisdictions.
Aneel, thank you very much for the introduction. Good to have Steppe Gold on here, you and Steppe Gold. There's a hell of a lot going on in the company. You've got lots of moving parts. You must be a pretty busy team. You've got the heap leach, which is ongoing. It's kind of an ongoing operation, and then you're expanding into this the fresh rock, and you've just announced a finance package around that of $150 million. Plus, you did a capital raise in May for $12 million. Can you just kind of talk to me about where you are in terms of the cash flow from the heap leach, the balance sheet, and how you're going to be juggling your budget over the course of the remainder of this year and into next year, please? Sure.
So yes, we are a producer. We're actually a profitable producer. We produce at around $800 to $850 all-in cost on this phase one operation, heap leach operation in Mongolia. That's been in production since April 2020. In April 2020, we started production for the first time ever during COVID with a 100% local team, and we produced 35,000 ounces over that 9 months.
Okay, so 25,000 ounces over 9 months, so about 3,000 ounces a month.
35,000 ounces over 9 months, yeah.
Okay, so 4,000 ounces a month. Is that kind of is going to be your kind of your average run rate?
That is our run rate. It will be a bit lower for this year and next, because we only have a couple of years left of mine life actually on the oxide mine without expanding, delineating further oxide resources or deposits, which we are looking at right now.
So it makes so you're kind of earning about, I don't know, $3 million a month. Is that what that generates in free cash flow as a venture, or is that a bit too punchy?
That's a little bit too punchy. Yeah, it's I would say roughly 2,000 ounces a month is our break even, right? We have to produce 2,000 ounces a month to cover all of our costs at site and all corporate G&A as well. So anything above that is definitely the punchy part, as you mentioned. And on a 30,000 ounce, I'm just using this as an example, 30,000 ounces of production, while $1,000 margin, so it's 30 million US of EBITDA. And then you got 30 million US for the year, and then obviously break that down with taxes, depreciation, sustaining capex, and you'll end up with about somewhere in the range of 10 to 15 million US of free cash.
What was the thinking behind the capital, the placement you did in May? Was that just because the balance sheet was just looking a little bit tight and you needed some flexibility?
Yeah, so there's two reasons. So one is we announced the acquisition in Peru of Anacortes Mining, which was an all-share transaction for roughly 20 million US. However, we wanted to capitalize the company with going into that transaction to ensure that Peru is funded for the next couple of years. We're essentially taking over the company with no cash in the till, so we wanted to make sure that Peru was well funded for the next couple of years. Not a lot of a spend. You're only looking at about 1.5 to maximum 2 million US a year spend for the next kind of 18 to 24 months in Peru. So not a big cash drag to continue to kind of de-risk that project, where we maintain our focus on Mongolia and the Phase 2 expansion, which is the most important project for the company today, given the production profile, the margin, again, $1,000 an ounce at today's gold price, and the life of mine of over 10 plus years, right? 12 years. That's the cash machine for the company for future growth, whether it's in Peru or additional opportunities in Mongolia. So we wanted to add a little bit more cash to our balance sheet for our current operations in Mongolia as well. So it shows you that there's an endorsement of the transaction in Peru at a premium to market. So we did it at $1.10 when our share price was lower than $1.10. It was a 4-month hold placement with no warrants attached. So this is long-term investors that understand the value of the company and happy to put it at a $1.10 price. Our CEO put in $2 million at $1.10. And obviously Eric Sprott continued to support our company. He's a 10% shareholder. His cost basis is well above $2 for the majority of his investment. He first made it in August 2020, and he hasn't sold. He's only bought more. So a strong endorsement of the transaction helped pad the balance sheet going into our project financing that we were working on, right? And it gave us more leverage. It gave us more leverage going into those conversations to finalize those conversations. And just less than 2 weeks ago, we announced that project financing of $150 million US that fully funds this phase 2 expansion without any further equity requirement. So now, when you see other project financing packages put together, there's a large equity component, usually 30%. So that would have been circa 40 million plus for us at these, dilutive levels. We were able to avoid that by doing that small placement to pad up the balance sheet a little bit. And put together a structure that's very equity friendly.
The funding package, $150 million in 3 separate tranches, each one of $50 million, each with slightly different characteristics. So one's a term loan, one's a senior credit loan, one's a gold loan. Talk me through, please, kind of when that gets deployed and when phase, where is phase 2 and when can you first start drawing down cash and how long does that loan last?
Sure. So first, phase 2 has already started in terms of construction. We actually, over the last couple of years, even when we had some of that downtime on the heap leach with supply chain issues, we procured the crusher. The fixed crushing circuit is not only procured, is paid for, and installed. So that's a big piece of phase 2. It's in terms of infrastructure and capex. That was about an $8.5 million US spend. So we've actually started on phase 2 previous to this announcement. Now we can get going on the remaining spend, and we have all the capital we need to finish off the construction over this year and all of next year. This year is camp expansion, some updated engineering work, design and engineering work, deposits on long lead items. So we have a flotation plant, we're building a tailings facility, and a power upgrade to grid. Those are the main big expenditures over the next 12 to 18 months for phase 2. And we'll actually start drawing. And I think this is where maybe the market hasn't fully understood this. We announced a definitive term sheet. Well, this is real. This is moving forward. And we're going to start drawing as early as the end of this month. Maybe within the next 2 to 3 weeks, maybe early August, we'll start to draw on the first 50 million US tranche that we have available to us. Maybe it's 5, 10, 15 million in that range first. We're only going to pay interest on what we draw. And the beauty of these tranches that we put together for the debt is the repayment doesn't start till at least 6 months after commissioning of the phase 2. So we're planning to commission phase 2 in the first half of 2025. You're not going to have this burden of principal and interest payments right out of the gate when you start your operation for phase 2. Because that's a big deal. You want to have a working capital cushion as you may have some kinks to work out when you bring a new plant online, and you want to have that. You want to focus on cash flow, not paying back cash immediately. So the structure we put together was quite friendly in that nature compared to some of the other offers we received from other banks, private equity groups. We went through a lot of groups and we spoke to a lot, and we were able to come together to a package that really is equity friendly. And it didn't put a big burden on the company in terms of payback. We can really focus on execution.
The interest rate on the first loan that you're going to be drawing down is the Mongolian Trade and Development Bank.
Yes, correct.
And that's at an interest rate of what, 13.4%?
13.4%. Yeah.
Is that fixed and flat? Or does it vary if interest rates vary?
No, that's fixed. Both are fixed. The 12% and the 13.4% are fixed, from my understanding. 34% is very competitive. Right now, business loans in Mongolia are 20%. Mongolia already has had higher interest rates. Obviously, over the last 12 months, interest rates have gone up about 600 basis points. So it's actually competitive on a global scale. You're seeing, we talked to, Schedule 1 banks globally, and they would come in at similar ranges anyways. Private equity groups coming in even a bit higher. So it is a competitive package coming from Mongolia. So for us, it's really nice to show, as a homegrown Mongolian company, built by Mongolians, supported by Mongolians and the government, to have the largest bank support us further in our further expansion here.
Where are you in terms of just kind of? I know you've just raised the $12 million, and you've got some kind of gradual income through the heap leach operation that kind of provides you with this kind of monthly liquidity.
That's right.
So, are you in double digits in terms of your kind of cash position at the moment? Because I'm just trying to work out why the share price is under so much pressure. And to me, the obvious thing is kind of balance sheet stress.
Well, that's obviously not the case. And even when our balance sheet was stretched, when we had that downtime for about a year in 2021, we never raised any equity. Our price was a lot higher. We could have been opportunistic then. And we really avoided that. Why? Because as a board and management team, we own 25% of the company and have never sold a share since we've been public since May 2018. That's huge alignment with our investors. We're always mindful of dilution, hence this package we put together. This allows us to skate through raising this massive dilutive equity this summer and continue drawing down on debt. We can service any interest payments from our cash flow, our balance sheet today, and our future cash flow. We're going to produce roughly another 70,000 ounces out of this heap leach over the next 2 years, give or take. Like I said, the margin there, you can see there's a net cash. That services interest. It services exploration on both of our properties in Mongolia and Peru with a little bit of cushion there. So we actually have balance sheet strength today. That's the beauty of our business. Even if we produce only 25 to 30,000 ounces instead of the 40 to 50 that we'd like to, it still adds net cash or pays our bills and more. And that's important here. We don't have to go back to the market to raise equity at any of these levels. That's what we thought was holding our stock back previously. People assuming that the project financing package would require 30 or 40 million of debt at 80 cents, or even though we raised money at $1.10 just in May, and we've just mitigated that. We've shown the market where the selling could be coming from. The pressure there's a couple reasons. One is the world, besides Asia, it still has a lot of issues for debt, high interest rates, inflation. So people have to sell any stock for a variety of reasons, and so there may be some forced selling that's as our liquidity has increased with all this good news in the last couple of weeks. You have selling to offset that, which happens, right? We see a lot of good news.
The risk off play and the kind of the liquid. I mean, I've seen that with physical gold. Actually, when there's a financial crisis, actually the gold price goes down because it's a source of liquidity. But
that's what happened. That's what happened during COVID. Gold actually sold off with every other asset class first, but it bounced back quickest and it hit all-time highs that summer. I think we're going to see a similar situation in our stock, just like we saw again in April 2020. We were trading at 90 cents. There was selling into good news when we started production for the first time ever. And then we hit $3 by August 2020, all on good news, right? So we cleaned through some of that forced selling for whatever reason. The second thing, I think, we did close the Anacortes transaction a couple weeks ago. That was an all-share transaction. So there are some legacy shareholders that have had enough, and now we've created liquidity through the Steppe as a producer platform. And so they're getting out, and that's fine. There's some shareholders that have had enough. They couldn't get out when they were holding their Anacortes shares because there's no liquidity. Through everything we've done, we've created that liquidity, and they want to get out. So to us, it's not a big deal because we don't have to raise any equity at these levels. We have good news, and we only have more positive news coming. I think when we announce our first draw, it shows how real the project financing is, how we're not tapping the market. And we also have this Hong Kong listing down the road, right, at the end of this year, which is a huge boom and catalyst. But I think that's an opportunity when the selling is done. There's not going to be, many opportunities for investors to buy at these levels, right? We're trading at a point. Sorry, go ahead.
Aneel, I really admire the enthusiasm. One of the challenges we've got is, if you look at the share price, it's been a kind of 2.5-3 year downtrend, and that's I completely understand that, in line with the rest of the market, and there's nothing particularly punitive to Steppe Gold for that. Everything's been traded off. The question is, in terms of the broader market may continue to drift sideways, or go down for another 6 months, for another 12 months. Particularly who knows when the turn is coming. I just wondered, other than kind of saying that there's a value discount here. What are the kind of the communication points or the action plan that Step's kind of targeting in the next 6 to 9 months that will hope it would be a catalyst for change?
Sure. So, well, I mean, this month already was a big one. Putting this package together that doesn't require further dilution is a big deal, because now it's all about educating investors, to showing you, hey, you have an opportunity to buy an undervalued stock that's trading at 0.15 times NAV, where our peers are trading at 0.6 times, or trading at $17 an ounce as a producer, where our peers are trading at $70 an ounce. It's education. We've done it before. It's a recovery re-rate. Buyers need momentum. I think they need to see the positive momentum on the share price. For whatever reason, people think there's something wrong. Well, we've just shown you the opposite. And so I think the news flow, the execution, continued execution, will demonstrate that. So drawing down on capital for phase 2. Further production updates over the next couple of quarters that shows that we have had no issues for the last 16 months of production. When we restarted production in March of 2022, we've continued to produce without any hiccups, and it's all been profitable. Expiration on this new oxide program that we have on the current mining license, to hope to extend that oxide mine by the current 2 years. So that's a big win if we're able to show there's more oxidized material that we can ship to this operation on the same mining license. That's the lowest hanging fruit for cash flow, right? Most investors aren't investing in.
The marginal value of any oxide ounce you can find, because you've got the sunk cost of the operation and the kind of the existing infrastructure, is the marginal value is high on 10, 20, 50,000 ounces you can find.
It's huge. That cash flow, again, it's not going to move the market in terms of more investors looking for a 30 or 40 or 50,000 ounce producer. That's not what people are investing in. They're investing in this phase 2 and then what's behind it. More than 100,000 ounces that can grow to 150,000 ounces per year. A 12-year mine life that can probably go to 15 to 20 years, right? We've already shown that with new drilling at depth, and we still have the rest of the mining license to uncover. I think it's important is, as our stock has drifted over the last couple of years, like others, we had, more issues to deal with, like COVID and our location with supply chain. So it was a lot harder to operate, but we actually still created value. We continue to mine, crush, stockpile. So when we hit the ground running with new reagents on site, we started producing and generating cash flow, paying off our payables, all that good stuff. Same thing here. We're continuing to create value even when our stock price is not reflecting that, and eventually it'll come back. However, saying all that, if North America takes longer, 6 months, 12 months, 2 years, I'm just using an example here, we're still, we're looking at the other options, as in like the Hong Kong listing, which we've mentioned many times to our investors and to the market. Something we've been looking at for quite a while, but now it's advancing. Now that we've closed Peru, we can advance. We're now just under 5 million ounce company with 2 assets and two jurisdictions. So we have multi-assets, we have scale now, and a production profile that could grow to over 200,000 ounces between Mongolia and Peru with what we own today. So that becomes more relevant in this market. People want scale, they want diversification. In Hong Kong, there's only about 6 other companies that trade, precious metals companies. So we're an Asian producer. So we're well understood in that region. That region that understands precious metals. It's culturally, it's in the culture, right? It's in our culture. I'm from India. So you have a lot of interest in precious metals. They love gold. They have a market there that's robust in Hong Kong. That's valuations are quite robust. So forget the recovery and re-rating I was talking about between the 0.15 to 0.6 or the $17 an ounce to $70 an ounce. They're trading at 5 to 10 times those multiples. On an apples-to-apples basis, and their liquidity is stronger. And we're not an emerging market or frontier market. Yeah.
What's the timing for the Hong Kong listing? What are you looking at now? Are you talking 3 months or 6 months or sometime later into 2024?
Later this year, actually. So once we close the Anacortes transaction at the end of June, it allows us to audit the pro forma company, consolidated company, which was required. So we actually delayed the Hong Kong listing by a few months already just to close Peru. Makes us more of a bigger company going into that listing. They love production there, and they love expansion that we have. And so we're on track, we think, for an end of November potential listing. So the window would open in November, and we'd have, price is right. Price has to be right, and we have the ability to close some of the valuation gap before then, and then bring in some new investors in that IPO.
Okay, so you do a kind of a small capital raise to give people kind of a starter position on the Hong Kong exchange.
Yeah, exactly. Yeah, there is a lot of demand. We've already done 3 non-deal roadshows between last fall, February, and April this year. The demand is there. The interest is there. The understanding is there. You know, there are other SOEs that trade on the Hong Kong exchange, up to $40-50 billion market caps, but we'll look very well because we are diversified, but we have production and growth. The ability to pay a dividend in future years. You know, once phase 2 is up and running, you have that cash. You can buy back shares, or do both.
You'll need the capital for Peru, surely, at that stage.
Yeah. So the beauty about Peru is it'll be a phased approach, right? So if Peru is ready to go, let's just say 2026, 2027. Let's just call it $100 million capex for phase 1 in Peru. By the way, Peru's phase 1 operation only, just phase 1, not phase 2 with the sulfide. Phase 1 has about 170 million US NPV at 5% at $1,700 gold after tax, and 270 million US NPV at $1,900 gold after tax. That's a you know, our investors are getting that optionality for free today, besides a massive discount on our current operations in Mongolia. So that would only require, I'm just using a rough number here, of about 30 million US of equity, right? So that's 30 million that we can contribute from our own cash flow in Mongolia and still have excess cash, you know, every year, right? Beyond that, 30 million self-funded equity that will come from Mongolia. So there will be some excess cash to do other things, right? If the market hasn't recovered, and we can't predict that.
And the desire for diversification, was that principally because of the experience the company had during the supply chain issues in Mongolia? Was that the kind of the light bulb moment? It's actually, you know, let's have a second country here because it just reduces the risk.
A little bit of that is not having one operation and having that risk, whether it's geopolitical, right? There's a war next door. You have COVID, supply chain, all these things. So it was a light bulb to have diversification. So if, let's just say, you know, you're in a place that has floods, like you see in South America, it's better to have an offset and have multiple production centers in case one is offline, you still have another one that's generating cash flow. So that is the thinking. Also, investors, talking to investors, being sometimes a pure play, doesn't matter any country, they want to see diversification. So investors want to see now diversification and scale. This was an easy way to scale up. You know, add 2.4 million ounces to our balance sheet for roughly 20 million Canadian. Okay, $6 an ounce.
Do you think the Canadian market doesn't it gives you a punitive valuation because of your jurisdiction and perhaps because of a lot of your senior management are Mongolian? Do you is there kind of lack of familiarity with the place and the culture that kind of weighs on your share price?
There definitely is. There definitely is, right? And we had to spend a lot of the first few years educating people about Mongolia, educating about how there's not the risks they think that exist. Talking a lot about Rio Tinto, and now all those things have gone. We've actually built a mine supported by the government and created the jobs. Rio Tinto's just recently in the last couple of weeks had a big site visit. The CEO is talking about how much he loves Mongolia, how great it is, how open it is for business. Xizhi Mining did their first public deal as one of the largest Chinese majors in country. Elon Musk had a meeting with the senior political staff there about talking about building a plant. Macron was there just a few weeks ago talking about strategic alignment on critical minerals. The U.S. government to set up also an alliance with South Korea and Mongolia and themselves. So a lot of things are happening today that are now certainly putting Mongolia on the map in a better light. We wanted to de-risk it through a smaller path with building this heap leach and showing there aren't any risks. The government's supportive. There's a local workforce that you can educate and skill. But yes, no matter how much we did, we still think there was a Mongolia discount. And you don't get that in Hong Kong, by the way. So that's also the reason how we're being creative to close that gap. And the Hong Kong market will connect into the Toronto Stock Exchange as well. So as the demand picks up, the liquidity picks up, I think the valuation will be able to close that gap between having this dual primary listing. So that's also part of the reason as well. on the listing front and diversification front. When I talk to investors in the States, if I say Mongolia, a lot of them think it's Inner Mongolia. I think it's China. I'm just to be honest, right? When I say Peru, they're like, they get it. It's there. It's in Americas. It's in Americas jurisdiction. It's a tier 1 jurisdiction. It's a mining jurisdiction. Even with all the noise politically, and you hear all the noise, projects have continued to advance, have been in production. I think they're the number 1 gold producer in the Americas still, number 2 copper producer. So, through the noise, that's where we're opportunistic. But creating that diversification is nice, and it builds our pipeline that beyond phase 2 in Mongolia, we do have other things we can add on and bring online. But there are still a lot of opportunities in Mongolia as well. I think there'll be more development or producing opportunities in Mongolia over the next few years. And I think there's still a path to get into a 250,000 ounce production profile in Mongolia by itself. And then you still have a Peru development pipeline as we see fit to bring that online. I
had a couple of questions about the Mongolian portfolio. One is kind of the polymetallic nature of it. I mean, you talk about gold production. What happens to the other metals? Can you recover them as byproducts, or will you recover them as byproducts in the phase 2 when you go into the sulfides, or are you just going to be focusing on the gold?
No, we're certainly monetizing the base metals. It's actually nice to have a little bit of base metal diversification in your own portfolio like that, right? Yeah, as you can see, investors, including the big corporates like the Barracks of the world, are looking for copper. Newmont just did as well. So they're adding base metals into their portfolios. Having it in your own mine is certainly a value. The base metal component for phase 2 is about 30% of their value, so it's meaningful, very meaningful today. So, just a reminder, our listeners and viewers, we are permitted for a CIL plant as well, which is not part of this current mine plan, not part of this current feasibility study or this build today. So right now we're producing a lead concentrate and a zinc concentrate with high precious metals content, and that will be shipped to China and monetized, obviously. And so we'll extract all the precious metals and the base metals. And there's a mine about 100 kilometers away from us. I've been doing that for a decade already, so nothing new. Very easy process there. And then down the road, we still have the ability to install a CIL plant, which will allow us to produce even more gold and silver. So we'll increase our recoveries from the precious metal side and produce more gold and silver on site, just like we're producing gold and silver bars on site today. So there is a lot of room to grow here. Both from the mine, we've already shown drilling underneath the current deposits at 350, 400 meters, that we have new extensions and discoveries. We're now stepping out, and then we have the optimization from adding a CIL plant down the road. So, this thing keeps giving, and it will keep growing, we think, from production profile and size.
Great, thank you. And then just in summary, what to look out for in the short term is the steady state or continued delivery from the heap leach, drawdown of the loan to show that phase 2 is actually underway, and then the listing in Hong Kong.
Yes, exactly. And in all that, we have some of this oxide drilling that may yield some very exciting results, because any of that is all gravy, right, for our current oxide operation. And if we can extend the oxide mine life, then our production profile will grow just from the phase 1 and phase 2 going on at the same time, 2025 and beyond. So quite a lot of news flow between phase 2 continuing, now that it's fully funded, no equity dilution, no overhang here for investors. And I think investors will get that. You'll see. I think you're going to see, the opportunity is not going to be here for too long in terms of accumulation on market. Any oxide drilling, and of course this Hong Kong listing, which is quite exciting, we think, from so many different metrics and valuation and liquidity. I think if we can't close the gap on market now, I think that's going to help us, certainly.
Well, good. Aneel, thank you very much for the update. It's good to see that the education program will be in your hands, so go get them. And I look forward to seeing the progress from the mine site in the months ahead.
Absolutely. Thank you so much.